Welcome to the other side of the coin, where we add new perspectives for you to make more powerful decisions in your financial world. Today's guest is one of my partners, Andrew Lavoie. Starting his career on Wall Street as an institutional investor, Andy's background and knowledge make him a leader in today's topic on the first principles of risk and decision making. Most people think of risk as something to avoid, a danger to be minimized. But the most successful investors and business owners know that risk, when understood and managed correctly, is actually the engine of opportunity. In today's episode, Andy will explain how to think about risk the right way, not as fear, but as information, and how you can use those same principles to make smarter, more confident financial decisions. Without further ado, it is my pleasure to introduce IM Financial's Director of Advanced Planning, Andrew Lavoie.
All right, Zach, welcome back to the other side of the coin. Andy, welcome to the other side of the coin. It's really a pleasure it's our first time meeting. Pleasure to meet you, and I'm excited to talk risk and decision making with you today. So,
yeah, thanks for having me.
Yeah. So we were saying right before we jumped on here, I got a little bit of a curveball before we get into all the stuff that you want to talk about around risk and decision making. And every conversation starts the same way. And we want to know, Andy, what was your relationship with finances when you were growing up?
Yeah, so my I know me and Zach talk about this a lot, and I know that Zach's background is quite a bit different. Grew up around a very specific professional view of money. We had it was different for us. My mom was a teacher, public school teacher, so fixed income, not like necessarily, on the high end of the dictated income range. My father he was a private sector employee, but again, we didn't make a ton. I think what I was exposed to the most was some typical personal finance issues like reining in credit card debt, trying to make sure you have enough to pay the bills in any given month. I guess if I had to summarize, I would say scarcity mindset was something that came out of that, which is just, there's a certain amount of money that we get to have, and then how do we, what do we do with it? There's often not enough to go around. How do you cut expenses? How do you do less, or, get by with having less to make that work? Which I do think I, internalized a bit early on. I think it was really important to me to, never have credit card debt and to always save. I think it sort of, once I became, got past college and was earning my own money, I think became a bit of, it wasn't really serving me as much anymore, just like absolute fear of not having enough money. Let me hold on to this. Let me keep it as safe as possible. Let me never let it go, because you never know if you're going to get it again. I think some of those things stuck with me, but a lot's changed in the past 20 years. About just what I've been exposed to, things I've gotten a chance to learn about, a lot of thinking that I've done around it. And I've learned that, among other things, you can sort of grow endlessly, but you can only shrink a certain amount before it goes to, before there's nothing left to shrink. So I think I've prioritized that above the scarcity at this point.
Hmm. Well, we're not going to have time to get into all the details, but I'm curious how you found your way into going from that kind of scarcity mindset into the personal finance world, and if you could bridge us from where you were then to what your role is at IM Financial, maybe even briefly how you, Mark, and Zach met.
Yeah. So I guess the quick version, when I did well in school, including at college, and people were like, what's next? Grad school, like, law school, what new educational thing are you gonna do? And I was like, it's been what feels like a long life up to this point of school and not working and not having money. So I decided to go straight from school into, like, kind of just an area of business that I had a really, really loose connection that, I thought I could possibly make a lot of money, which was kind of my first way out of that, right? Just the idea that there's sort of a certain caliber of job that you get at a certain age, and there's a limit on how much you can make. I sort of wanted to challenge that immediately. When that started kind of working out again, I really shifted my focus to saving. And I think I was also working notably or relevantly in public stock markets. So my actual job was to sit at the Bloomberg screen and watch everything move up and down every single day, multiple throughout the day, different ways during the day, and it's just a very acute view of that risk. I think maybe best practices for the average person is like be an investor, but don't check every day. Check every quarter, check at the end of the year. Try to avoid looking at it till it matters. Did not have that option. I literally had to watch it every second, and it's hard not to feel it. Physically, just to just feel those like losses and com- coupled with my experiences growing up, I was not eager to get into the risk taking side of saving and investing. So it was a lot of just regular saving, thinking aggressively about how to do things with money that weren't maybe that how to do maybe unusual things with money. What is my future after this? Because I think you start to realize almost any kind of normal earnings level outside of maybe owning a business that's thriving or you're earning just tremendous amounts of money or many years into certain kinds of careers, there's almost no amount that you can earn that you don't start to sort of do the math and say like, well, it's going to be really hard to just save my way out of this, where like I will have set aside X number of dollars a year and then I'll have so much that I never have to work again. So you kind of realize you have to do something else. And what felt like the options for what to do did not feel comforting to me. So I sort of started, even while, I ended up working in that job for 13 years, which maybe is longer than I expected during it because it's really hard. There's a lot of times, lots of people in that industry talk about how much they want to get out and do what they really want to do, like be a chef or, whatever the thing is that they want to be doing. It's never that. But, it's hard to be like, how do we make this much money doing something else? How do we get by without making a lot of money? What are we going to do instead? So I started investing in real estate a little bit, which I had the opportunity. The housing crisis was kind of a time that like I had money. I hadn't really started investing yet, so I didn't lose anything. People struggled with credit. They weren't giving out a lot of loans, and it was like large discounts on housing. So it was the first time I bought a house for roughly investment purposes in 2009, which was one thing. It doesn't necessarily generate a life-changing amount of money, depending how you do it right off the bat. So that wasn't really an answer, but it felt good to be investing in something I understand. It's something people understand too. I think that's something people like about real estate. Like I get what a house is. I know why it has value. I know why it will have value in the future. I get how, a person would pay for it. Like this just makes sense. We've all seen houses, we lived in them, we understand rent. So I like that about it. A couple of years later, I had a friend who had a startup, and I was like, I think the infrastructure, the ecosystem around investing in private companies was very different then. But also, I just didn't have a ton of experience. So I was like, well, I have a friend who's starting something. Like that's an opportunity to invest in one of these early stage startups. It's not easy to come by those opportunities. This makes sense. I like it. So I invested a little bit of money in that. It was a very small operation, and I felt kind of early on, I'm like, I think I could even help move the ball forward here a little bit. So I was like, my money's now in it. I actually care about the outcome. Let me try to control the outcome a little bit. So I got kind of engaged with that. What happens in a startup sort of by accident, but also, what it's like to invest in one, what that risk profile looks like, what goes on inside a startup, what the challenges are, which, led to ultimately, in sort of an indirect way, the job the first job I would take outside of finance, where I was doing, I guess also just a slight aside, during that 5 years from 2013 to 2018, I also got a little more heavily involved in real estate. Continued to make sense to me as a way to, like, you could sort of see a path to that, paying you consistent money. Try different ways of real estate investing, even within that world. I got involved in things did change. You sort of became able to invest in different kinds of companies more at like smaller levels, without writing those big like venture capital checks. So I started doing a little bit of that. Right. It was always that same thing where I'm like, I know that I'm going to need more later. I can't do this job forever. I don't know how much I'm going to earn. So like, what are these other things a person can do? I still didn't have like a really structured way of thinking about where that goes, like where that ends. But it was just like, let me do a lot of things, because if one of these things works out, that'll be good for me. Like it was thoughtful in its own way, but I think jumping ahead a bit, I've learned a lot more in this world about how to be really intentional about that. But when I did, take a job through those channels from that original startup investment, it was a professional services organization, so not really a tech startup type thing. I was operating in like a CFO capacity, operations, um, discussing how to be more efficient within the business, how to financially report properly, how to think about how we're getting the financial results we are, how to change those, what levers to pull, how to operationalize things. So I had like 4 years of on the ground kind of normal business experience, from like a leadership angle. And then it was at that point, that company was taking a bit of a different direction than I think where my family life had taken me. It just didn't seem like the best fit for continuing to go down that road. That's around the time that Zach and Mark, my now partners, found me, and we started having conversations about this. I understood that personal financial advisory existed. I had never really availed myself of it. I had a personal investment money, of my own with the investment arm related to the bank that I had just been using because it was a different bank one day, and then just by chance. And they would call me and they were like, have you thought about talking to us? Basically trying to tell me about advisory services. And they're like, well, they threw out like one or two, I guess I would say, ideas. And I was like, well, that's fine, but like, everybody says that, but here's how I'm thinking about it. Like here's the tax profile versus liquidity of like putting this into retirement funds or not, and I don't know what I'm going to be doing with, just my point is my particular situation is this, and here's how I think about it. And he was like, oh, I've never actually really looked at it that way before. And I was like, yeah, exactly. Like, this is why I wasn't talking to you, and I'm still not like this. Like, there's not a lot to add here, right? Like, I've heard kind of the talking points that people give. Like, I just don't believe that you're going to do anything very interesting that like I don't know how to do or couldn't figure out how to do, or just like that I'm going to trust you to do it. So I kind of had a negative. I also felt like I had been around the markets long enough that like maybe if it's not a good idea for everyone to do it themselves, that maybe I could, which is probably a little bit untrue. Probably lots of people think that, but also I maybe had a little bit of rationale behind that. But I kind of wanted, as I started thinking about working with Zach and learning about how they were doing things, I kind of wanted to know like that it's not that, right? Like I'm like, I understand, there are certain ways to, let's say, charge for this, or certain ways to certain things to recommend people do, and it's not like obvious that like the value is there in all cases the way that everybody does financial advisory. So I wanted to kind of hear that there were different ideas that I didn't already hadn't already known about, that there were other sides of this, that there were ways to be more strategic about the entire thing. And I did. I think I probably Zach would agree. I don't know, Zach, you can answer this, but that I pushed back a lot, that I didn't make it easy for him um, during that process.
In
I
a
had a lot of
healthy way.
questions. Yeah, yeah. I really wanted him, to put him to the test and get answers that were interesting. And I felt like by the end of that long series of conversations that it felt like this maybe did make the most sense, is the next thing that I'd be doing. It's sort of like, bridging back to what I've been always, what I've had the most success with, and what the kinds of things that I've been best at in terms of my like talent and skill set, but applying it in a new way that I hadn't thought about doing it before, that really kind of fit with everything that I wanted to be doing.
Mm-hmm.
Yeah, and
So
I think Andy's background. Mike, did you want to ask a follow-up?
go ahead, Zach, and then I'll move it along
I was gonna,
after.
s- I was gonna say, I think Andy's background, working with the startup and, in the institutional investing world, looking at, the Bloomberg machines all day and watching the ebbs and flows, second by second in the markets. I think it really has given him a unique perspective on finances and how to manage money and how to run a company. Where he was saying before, I actually really like the line that you can only shrink so small, but growing is endless. I think, so many times people are only viewing the upside when it comes to finances. And given Andy's background, something that he talks about in our office and with our clients are, the difference between the Sharpe ratio and the Sortino ratio. And it's really understanding not only the upside, but it's also understanding, what risk are we taking to achieve the upside, and how if you handle that incorrectly, a downside could even be more impactful than a positive, right? So I joke sometimes and I say that I hate quoting Warren Buffett because I think it's a cheesy thing for financial advisors to do. But he has one quote that I really like where it says, rule number one to investing is don't lose money. Rule number two is see rule number one. And I think that people might, intellectually say that or, understand that, but we don't always see them actually implementing those principles into their life. And I think just given Andy's background, I think he's kind of like the perfect example of somebody who it's not just noise, it's the implementation of these principles as well.
So a really quick catch, actually, before we move on. What were those two ratios? The Sharpe and the Sorrentino, is that right?
Yeah, Sharpe and Sortino. Yeah.
Sortino. So what are those two ratios?
So the Sharpe ratio is a commonly used way to measure the risk reward ratio of a package of like a portfolio, essentially. I believe that's the most commonly used one, or it's definitely the more commonly between the two. The Sortino, I think, is more interesting, and it gets a little bit into what matters when you think about risk. But Sortino is the same thing, except instead of measuring the volatility of something, how much it moves up and down, which is like not exactly how, like, when people don't want to take a risk, that doesn't mean they don't want a thing to move up and down. Like, that's a weird definition of risk. It's how much you can lose, how much it moves when it moves down, how much downside risk there is. So it's still risk reward, but it's considering the downside, which I think just resonates with people more. I think mostly when people think about managing risk, what they want to be doing is managing their downside. Like, how is this going to not go bad for me?
Right. People want to make certain they're not going to fail, right? So it's like when somebody gets close to retirement, we're actually working with some people around this conversation right now. Somebody gets close to retirement and they put their, finances, their assets, their liabilities into a Monte Carlo simulator. And then that Monte Carlo simulator says, you have a 90% chance of succeeding. And the first thing where people's brain goes to is, well, what about the other 10%? That 10% chance of failure sounds really high, right? So it's, I think it's kind of humanizing finances, not just talking about the shiny objects of where, the potential could go. It's also making it a little bit more tangible and realistic to understanding, like I said before, like how much risk am I actually taking to achieve these hypotheticals?
Yeah. So, Andy, I'm wondering if you could set the table with defining what risk is and how you look at risk and the multifaceted way that you look at risk, right? Like I think all of us, when we hear the word risk, we have our own story about what that might mean. You seem to have a very nuanced approach to and a nuanced understanding of what risk is. So what is risk, and maybe what are some of the different dimensions that you look at it?
Yeah, so I think a useful way to start answering that is, what do I often see in the industry as definitions of risk that get used, and what are they missing? So you can sort of fill in the gaps. And one of them, you asked the question about the Sharpe ratio. It is interesting that, like, volatility, basically, again, I don't want to, paint with too broad a brush, but I would say generally the measure of risk that's used is volatility. Those words are used a little bit interchangeably. So like standard deviation, volatility, and risk are all taken to mean the same thing, and that's how much a thing is going to move. That like is a factor in risk. I think you can sort of intuitively understand why that's a part of risk, but it's basically the go-to measurement, right? If we want to take less risk, we choose a thing that is less volatile. If we want to take more risk, we choose a thing that is more volatile. It's like that might be true like of a specific investment, like I think you could probably even quibble with that. Again,
isolated in a vacuum.
Yeah. But I don't think that's, what people mean. And I think the other thing, this is less used in finance. I think it's interesting. Well, I think it's used a lot in like high finance, less in personal finance, but like expected value, right? So if you have a 50% chance of you're going to do a bet, and you have a 50% chance of making $100 or 50% chance of making zero, or that expected value is 50, right? You have a 50% chance. You add up the probabilities and the values you get at the end. So that is a really kind of normal way to think about betting in the institutional investment world. It's a thing that gets talked about in economics. I think it applies to personal finance. I think it's also still missing something, which gets one of the things that we think about. I think as a group, I don't know if Zach would have said it exactly this way, but I think blends right in with what what we're most often trying to accomplish. Is one thing is kind of glaringly missing from the expected value computation, which is, the second part that doesn't always get brought up, which is, can you tolerate the downside, right? Like, it's not, if you have a chance to do something and you could, let's say, double your money or lose it all, it might be a 50-50 chance that the expected value to you, mathematically, I guess you would say it's that 50, but it's, if you can't tolerate losing it all, if that would be absolute destruction for you, you have to consider that maybe you don't do that bet no matter what the expected value is, right? Like, there's a second question that's not quite as quantifiable, which is, can I do this at all, right? It's not, well, 90% it's probably going to be fine, so I should. It's not worth, is it worth the upside? What are you trying to accomplish, right? These are questions that you do ask a person or a family or a business. What are you trying to achieve with this? How much do you need or want that thing that you're going to get by doing it? How much do you not want the opposite, the downside that comes along with it? Which really doesn't play into the expected value calculation at all, which all leads, I think, to probably the most important thing, which is understanding the difference between probabilities that play out over, large sample sizes, over many interactions, versus what that means to you when you're a sample size of one. And they're completely different. There is no such thing really as like a 90% chance of a thing that's happening when it's binary and it's you. It's either going to happen or it isn't. Understanding those probabilities matters, but you don't really get to have like 90% of the good outcome when you're the 10% that got the bad outcome. You just get yours. You get 100% of the bad outcome, and you don't get to play. Well, it depends, right? It depends what we're talking about. So if you have $10,000 to invest and you do 10 different $1,000 bets, you're starting to build up a sample size of like where maybe those individual probabilities do get a chance to play out. They get to play out 10 times the way that you have done this. Or, if you take a certain part of a pot and you invest it and you save the rest, you might get to play again, right? So you could lose it all, but you didn't lose it all. That does start to speak to, thinking about asset allocation. But I think people gloss over that in their thinking of this. You learn a little bit and you get kind of dangerous where it's like, well, actually, the expected value is this, or actually, where there's a 95% chance that this is going to end well. And they just don't even consider that 1 in 5% is 1 in 20. Like, are you okay with that? Are you okay with a 1 in 20 chance of this actual bad outcome? It's not really a blended outcome. It's binary for you. And how many times are you going to get to play at this? This is kind of a bit of an aside, but it's something that I don't think I've heard anyone say. So I think it's interesting. When you think about how statistics has gotten involved in sports, baseball might have been the first place it was done the most. And that actually makes sense because there are so many plays in a baseball game, and there's 162 games in a year. So, and they're all kind of equally meaningful. And the number of times that, like, let's say you're making a decision about what to do on a given pitch, there's so many pitches in a game times 162 games. You really start to get these massive sample sizes where if you're right 80-90% of the time, or even 60% of the time, more than half, it's going to get a chance to play out in your favor and you're going to get the outcomes you want. So like understanding that stuff really matters. When you start to introduce it to other sports, and I think about football, there's been less adoption there. I'm like, oh, it's a cultural thing. It's, these old school guys don't want to do it. I think that it doesn't match their intuition because for probably reasons that make a little bit of a sense. There's only 16 games. There's 10% as many games, 17 games. There's far fewer games in a football season. There's fewer of this similar play, right? So you're only kicking in that one game, part of a short season, one time with 5 seconds left, right? Or, you're making that decision to punt. That decision is not coming up hundreds of times per game, hundreds of times per season. It's only coming up a bit. And I think, I'm a Patriots fan. I remember the Seahawks Patriots Super Bowl very well, but people talk about how, Pete Carroll made the right decision statistically, over time. That was the right decision. It just didn't work out that time. And I think that is a helpful way of thinking about, like, look, you can't control outcomes. You can control the decision making. And without, I think what makes people angry when they're on the wrong side of that is like, he doesn't get to do that game again, right? He's not going to do that game 100 times and win it, 75 times. He lost the one time he did it. And, you don't always get to go back to the Super Bowl. Sometimes that's just your Super Bowl. Like, playing the odds versus like, can I accept the outcome of this thing going wrong? It is a different way of thinking about it. And I think that's how it plays out in real people's lives. I think, again, one investment, you can make a small investment with a small amount of, for example, a small amount of your funds, and it can go to zero and you didn't maybe fundamentally change anything about the rest of your life if it was sized properly. That can play out for one person, But I think the way that we operate in this business, looking at the entire strategy, the entire plan, you really get one chance, your life, your lifetime, one earnings period, one earnings career that you get to save up that money or not save it, invest it and lose it or not lose it, grow it or not grow it. You don't get to go back a decade and try it again. You got your shot at that decade and then it's over. And then you kind of reach retirement age and either you can or can't work and you do or don't want to, and you did it or not. Like you get one. And so if we have 1,000 clients, some people in our position could choose to think if 900 succeed, what a great job we've done. These are people that we know, that we get to know or knew already. We're not really comfortable with out of 1,000, 100 families failing. So, when we think about risk, it's really, you have to take a completely different view. It's not a big expected value calculation. It's not a Monte Carlo simulator. It's understanding what can happen to you and retaining positioning and flexibility. So I think that, how do I think about it in that context kind of has that answer. You have to think from first principles, like, why am I doing this? Why would I do this at all? What am I trying to achieve? What's the best way to get there? Not in best practices or, what's the best way for a person my age to invest? Like, oh, it's this probabilistically. This would have worked out, 8 times out of 10. Like, that's not the answer for you. It's what can I tolerate as an outcome and how do I make sure that I get that outcome? And then how do I get that outcome while opening myself up to the possibility of more, right? You kind of have to protect that downside first. Understand that no matter what outcome you'll get, you will be okay with it. And once you are standing on that foundation, you get to reach for growth. You're not playing a statistical game. The answer to that, what are the odds? What's the blanket, cookie cutter best approach to this is never the answer for you. It's always going to be about positioning and what you can tolerate. So it is a completely different way of structuring a plan.
So I'm curious, like, what are the ways that was a really thorough and thoughtful explanation. I love the MLB and NFL. You sent me notes beforehand and you said MLB versus NFL, and I have no idea what Andy's going to say, but it's an easy example to follow, right? There's just in an NFL, in a league where there's 16 games versus a league where there's 160 games, probabilities make a bigger difference in baseball than in a smaller sample size. It's just like basic mathematics, but I'm curious how you bring this, like, how do you assess and address risk within the different the clients that you work with? Like, what do these conversations look like? You've really set the table well for how it's a pretty individual choice, right? Like, people need to identify what their tolerance for risk is. So I'm wondering how you combine your knowledge, you know a lot about this, and bring it into conversations with the clients that you guys have.
Yeah. So I think I think everything that people do, even when I would say that they're not doing the way that I would recommend, always makes sense given the definition of risk that that they're using, right? So I don't think people are trying to do the wrong thing either on the advisory side, or obviously people are trying to do the wrong thing for themselves or their family. I think if you're led to manage volatility and that's all you know how to do, or play by the odds, like, they're doing that. They're doing what they think is the right thing to do. I think the first step is really just level setting in the way that we do in different ways as a group, but all of us do it, which is to reset that person's definition of risk so we all agree on what we're managing, right? What outcomes are you really trying to avoid? Can we make sure that those are avoided before we start thinking about other things? There's a story. I read that this was a book. We have lots of books that we share with clients. But he tells a story. It's basically a couple, and they're invested a certain way, through the tech crisis, around 2000, and it's emerging in 2002, 2003. Person comes to an advisor and they have, I think in the example it was like $3 million, and they had retired with $12 million, and they now had 3. So for their plans for deriving income from that, basically everything had been eviscerated. And he kind of was asking questions about how did you come to the conclusion to do that? And it was essentially, the answer turns out to be that they were hoping to double it, right? Like they could have gone from 12 to 24 with by earning 10 or 12% a year, basically investing in the kind of stocks that had done well before 2000 and then very badly thereafter. As what happened to them probably happened to a lot of people. But, you know, the second question is, how would it have changed your life to go from 12 to $24 million? And they thought about it, and the answer is not at all. You know, they didn't want 24 any much more than they wanted 12. It wasn't really something they were trying to accomplish. And, how has it changed your life to have 3 instead of 12? Well, everything's changed. Everything is worse. We have no idea what we're going to do. So I think if you would just really, the only thing you need to change is not like knowing what to invest, right? It's not about predicting the future. We're saying actually, large cap tech stocks will do well until 1999 and then not thereafter. You just don't have to play that game at all. You don't need to think about the odds of doubling your money. Of doubling your money won't do anything for you. You do need to think about the possibility of not having the life you want if this goes the 5% way. And I think just so, to bridge it back to answering the question directly, level setting on like what our definition of risk is, I think is the first point. And then, so what do you do when you are a sample size of one and you we don't throw probabilities out the window, everything that we do, whenever possible, we try to make it research backed and, what has played out the most and provable and reliable ways over time in as many different environments as possible. But the answer always comes down to positioning and flexibility, because another kind of, I guess, mistake or something that we don't adopt that you see a lot in the industry is like, everything's going to continue as it is now, and you're going to do this for 10 years or 15 years or 20 years, and then you will need this, and here's how you will get it, because this is what will have happened. Like, that involves so many inputs, right? So many things that may or may not happen that may prove it false anyway. But probably the biggest thing that's most likely to not be true is you will keep doing this, and it will keep playing out this way for the next 15 years, right? Like, that's the thing that is most unlikely to happen, right? You're going to, have a kid or, lose a family member or, move towns for some other reason, switch states, change the way that you live in homes, like nothing ever actually goes that way. So it's just a bad approach to planning. The correct approach to planning, I think we would say, is plan for flexibility. Know that you can, as things change, you have the most optionality is another kind of good word for it. The most possible places to pull from, possible ways to pull, no matter what's going on in this market, that market, interest rates, inflation. People want to know what's coming next on those fronts, but the correct thing to do is just understand that those things will have impacts, and they'll have different impacts on different things. And do you have the right things? Do you have the right system in place, the right setup in place, that when things change for you, when things change in the world, you have a place to go to resolve that problem? You have your answer to that question. And like, some of those things won't happen, right? Like, of the, of 10 risks you can identify, like 2 of them will affect you acutely. The problem is none of us know which 2 and when. So you kind of need an answer for all 10, and maybe it's not maximally efficient to plan for a bunch of things that don't happen. But what matters a lot more than that is that, it's really inefficient to lose half of everything, just as for example, things you can't recover from are ultimately more important than efficiency. And that's how, we talk about the overlap between this industry and other schools of thought, engineering. That's how they look at it. No engineer would only plans for efficiency. You don't have no backup servers because it would cost extra energy. You don't have no backup supports, or you don't plan a bridge for the capacity you expect it to use, right? You plan a bridge for the capacity, double the capacity it might use, just something like that, some excess capacity, some backups always, because, in a hospital, if the power goes out, it's not like, well, it was too costly to have backup systems. Like, people die. You don't get to then just get the power back, a month later. You have to have the power now. You have to have it. And if those backups are a waste, all the days the power doesn't go out, it's a waste that you voluntarily accept.
Right. Yeah. The work that we do, just to Andy's point, and all very good points, the work that we do, it's just too important to take a chance, right? So where we always emphasize efficiency, right? Everybody wants to be as efficient as possible. There's also a time and a place for redundancy, right? Like in the engineering world, you just can't take that risk or that chance of things not going the right way. But yeah, I mean, I think Andy made so many good points. And in addition to an individual or a family or a business identifying, what risk means to them, I think a large portion of where strategies aren't being optimized is because people aren't understanding strategies on how they can, get closer to their goals while mitigating risk at the same time, right? So if your goal, if accomplishing your goals means you need more money, just in this arbitrary example, that doesn't mean, well, invest it as aggressively as you possibly can, and hopefully your bets pay off and you're going to make a lot of money. We've mentioned it before, Mike, in the previous podcast episodes that we had, where we're always following PhDs and people who take finances and make it scientific, right? So Andy, I don't know if you want, everything you were just saying, it kind of was making me think about postmodern portfolio theory and how you can actually be adding, I'll call them bets, like Andy was saying, and you can be adding bets to create a better environment of success without necessarily taking more risk. And like Andy said, everybody's doing what they think is most appropriate. Even financial advisors aren't doing things the way that they should often, right? They're doing what they think is most appropriate, but a lot of the times it's just lack of information, lack of knowledge, following people who make the most noise on, social media and television, rather than people who are taking the most academic proven approach. So Andy, I don't know if you want to use that as a launching pad. I think maybe that could be an interesting topic to discuss as well.
Yeah. So that's a conversation we have with a lot of people as we start to expand portfolio construction, because the basis of this, a lot of people know about modern portfolio theory. I think it's fairly well publicized, and that basically the big insight of that, or the big outcome that I think everybody just takes as a fact now, but up to that point they didn't, is that you can. It's originally applied to stocks and bonds, and I think it usually still is. Which is that, like, if you have a bond portfolio that might pay, just to make something up, like 4% interest, so your 4% expected return, and it's completely safe, there is a threshold up to which you can add equities, stocks, which is riskier. Inherently, the stock bucket is riskier than the bond bucket, but you can add stocks to that portfolio, adding risk and return, because the expected value, in this case of the stocks, would be something greater than 4%. You can add risk individually, but and increase the return of the portfolio, but the holistic risk of the portfolio is reduced. You actually have less risk, and that's because different things impact the returns of equities and bonds. So if the most obvious one, if interest rates go up, bonds go down. If interest rates go up, your bonds will go down in value. If you have stocks, it's not as clear. It may go down less. You may have other gains from the equities that offset that. The point is just that there's more than whatever exact description or explanation you want to apply to it, is that you can add risk in a silo, in a micro focused view, without adding actual risk, or while actually reducing risk. And to Zach's point, that's a good one. It's not about shrinking your goals to say, like, well, I don't want to take risk, I actually can't accept the downside, so I'm just going to stay in cash. That's never actually the outcome. It's rarely the outcome. I think that we're talking about there. You can be really intelligent about adding risk in other ways. So what Zach alluded to, postmodern portfolio theory, which I think is less talked about, which is where you start to introduce that concept from earlier about managing downside risk, right? We don't want to, it's not necessarily a worthwhile goal just to reduce volatility. It is a worthwhile goal, I think, for more people to reduce downside volatility. Like, how much do I lose when I lose? How likely am I lose, and how much do I lose when I lose? So that shift is to postmodern. And then I think a shift in our conversation and the way that we think about it is, well, within stocks, what are the riskier buckets? What are the less risky buckets? And how are they correlated, so that when maybe you add certain things that have higher returns over long periods of time based on the research, those things might be individually more risky alone, but when added to a bucket or added to a basket, in fact, your overall risk is lower and your expected return is higher. And then what if we look beyond, public stocks, after we've exhausted all of those? What else can be introduced that might have a different correlation and different return drivers, where maybe this thing is individually considered more risky, but as a part of the whole portfolio, you're now have even less risk and possibly, the same or greater potential return. I'm not going to make any, recommendations here or speak to like what in all cases that thing is, but it is a way of thinking that, as we diversify, that's a really, common word in the industry. I think everybody knows diversify good, but but it can also, there's ways that look diversified that you're not actually as diversified as you think. I think really common methods of diversification are actually pretty concentrated, looked at a certain way. So just like bringing an understanding to the table of what is true diversification, what's really going to minimize, downside risk, overall risk, volatility, and still potentially, hopefully, be getting you even closer to your goals, but in a really, really intelligent, really well thought out way. And then I that does kind of bridge the gap to me to talking about one other thing. It seems like a lot, and I think sometimes people come to us. I remember nobody talks about this now, which I think is the point. But the I bonds, everybody's question like 1.5 years ago was like, what do I do? Like, how much do I do? Is this a good idea? It's like, it's fine. I bring that up because how to think about decision making. One of my favorite kind of frameworks for that is, essentially how consequential is the decision or how impactful is the decision, and then how reversible is the decision. It's like kind of a really small matrix. And I think that we try to, and I think that people should invest their time in getting it right when the outcome is really, really meaningful and when it's irreversible. Some of these things involve long time periods. So, anything that has to have 20 years to play out or should have 20 years to play out is essentially irreversible, right? You don't get to play out that 20 years again. One lifetime to retirement is irreversible. There's degrees of reversibility for sure, but I think thinking about that first and understanding like, if I get this right or wrong, what will the impact be? Is it going to matter? And if I make a decision, but I actually realize it was the wrong decision, like, is it going to cost me a couple dollars in fees to, sell back out of it? Or am I going to lose everything? Or am I going to not have another chance? Well, I've missed my one chance to do this thing. So I think you can avoid you can properly apply your focus to places where it should be when you don't waste time on the many, many things. Like, again, nobody asked about I bonds. It did not matter. Like, people did or didn't get more interest because they did or didn't do that to some degree. It probably changed almost no one's life, and they're kind of not interesting anymore. Like, if you invested any time Googling whether you should do it or not, you probably wasted too much. And I don't think that like people spend the same amount of time learning about, they're like, well, I think I obviously know the right thing to do here. They don't necessarily. They haven't done the time. They haven't put in the research. And like, yeah, it's a lot of work, but some of these things are really consequential and really irreversible, taken from one angle or another. And when we focus on those things, we can really, really change outcomes and shift people's focus away from maybe where they're hyperfixated. And in fact, it's not going to change their lives one way or another.
Yeah, and sometimes you just have one shot. And I don't know if Andy ever even heard Mark say this, but I just love how the partners at our firm, how in sync we all truly are, and how our values are, so similar and aligned. Because something that Mark has said for years, I don't think Andy ever even heard him say this before, but Andy essentially just said what Mark has said in the past, which is there's a difference between a small mistake and a big mistake, right? Nobody's perfect. Life's not perfect. Markets aren't perfect. I mean, I think anybody can appreciate and understand that, right? Nothing's perfect in life, but there is a difference between a small mistake and a big mistake. And it is so often that we see the general public or the masses, like Andy said, getting fixated on items that might not move the needle or change their life, and then kind of kick the can on bigger, more complex and sophisticated decisions just because they're harder and just because they're going to take more time. But really, that's where you should be putting your time, right? You should be allotting your time in the irreversible, one-time opportunities, not kind of like what's trending right now.
Mm-hmm. Well, in the interest of time, Andy, I think you only mentioned it one time today. I was expecting to hear it more, but first principles, it did come up. You did mention first principles at some point, and you started to get into a little bit about what at least the context lended to. You seem to be speaking a little bit about what first principles were, but I would love to explicitly get into what first principles are and why you think they're important. Like, what's important about first principles?
Yeah, I do think it's really important. I think when you want everything that we talked about today, like if you could do it, right? If you could like, improve risk-adjusted returns over a long period of time, if you could avoid all the bad outcomes you want and still get the positive outcomes that you want, if you could do those things, I think everybody should probably agree that that's a good thing. And like but when you look at what the industry does, it's not really aligned with getting any of those things, or at least to the degree that it should. So like, why? What's the difference? And I think it's this kind of, what, again, like it sort of relates to the earlier issue, but what's the cookie cutter? Like, what's the takeaway? If I Google this, what's the first result? And it's sort of like, this is the answer for everyone. We're just going to keep applying it across the board. In order to get to those much more interesting answers, I think you have to take a different approach. And that's where building from first principles comes in to me, which is, what do we actually want to accomplish? Forget about like, oh, this is the standard. This is what I've heard you're supposed to do. This might be like lower in fees than that thing, and I don't like paying fees. Like people come in with sort of like preferences that clearly came from somewhere. But I think if you throw all that away and start over, and you're saying, what do we actually want? What is the thing that is most aligned with what you want? What would we design from scratch if we're designing it from scratch? Not like, well, this is what I have from here. This is what I have from there. I heard this, like my cousins did this, my uncle did that. I think I like those things. Like none of that, none of what you Googled, it doesn't matter. Like, why would you design this from scratch if you could only think about like, what does this tool do? What's the bad outcome? What's the good outcome? How do I mitigate that? And I think that's what we do really well. I think you can't get to some of these answers if you aren't thinking in sort of a first principles perspective. And I do think about, it depends. Like we're in an advisory position. It's really nice sometimes to be like, here are the factors, go figure it out. But unfortunately, as advisors, we actually have to tell people in certain cases what we think they should do. But I think a lot of times you get an answer that's a bad answer, which is, it depends, like, oh, should I do this or that? It depends. Like that is a bad answer, especially in an advisory context. It's also like true all the time. So the difference between that as a bad answer and a good answer is, what does it depend on? And what do you do when you get the different variables that it depends on, right? Like if you can explain that, then you actually understand the thing. It's not just, you're not just checking out of the conversation saying like, yeah, that's a hard one. I don't know. Like it depends on this and this and this. And when if this is what you value, this is what the answer is. And if this is what you value, this is what the answer is. Like, how willing are you to tolerate, this possible outcome, right? That's what it depends on. And now we know what to do. So that also, you can get to those answers. Like where do the exceptions come in? When does the standard version not apply? You have to understand from the ground up, like why were these things introduced at all? Like why is this the go-to plan? How did you get there? So that you can know when it's like, well, that's actually because it's usually based on these conditions and they don't apply to you. So we're not going to do it here. We don't get thrown off when something is different than usual because we know why everything's in there, because we built it, in a sense from scratch.
It's also making me think about the 4% rule for retirement, right? Where people are going to follow it because it's kind of like a hot topic and, it sounds good. People have been saying it and doing it for decades. If you Google retirement strategies, you're going to see it. Andy actually wrote an article that's on our website about how the person who created the 4% rule, even he says people shouldn't be following this rule anymore, right? But I almost view it like, a train that's moving 500 miles per hour. If you pull the emergency brake, it's still going to skid forward another 500 feet. So I think people are becoming more aware. But, when things have such a chokehold on the way that people are communicating in our space, it can take years, if not decades, to see that change occur. And I think it's really interesting. I think it was in 2022 that the person who created the 4% rule, which I think was maybe 1997, it was in the 90s. And he's actually being vocal about how things have changed, times have changed. It doesn't apply anymore. Yet we still hear people joining our meetings and talking about it.
So I actually, as you're talking about that, I've never heard of the 4% rule before. So what is the 4% rule?
It's most often taken to be, and again, this is a case where I think there's a lot of, like, it's a research study and there's a lot of conditions, but the takeaway that nobody knows the conditions anymore is when you get to retirement, you can safely take out 4% per year. That's the safe withdrawal rate. If you take out 4%, you're fine. That's kind of that's the takeaway people have. That is not what I am saying is, but that's the 4% rule as people know it. Bunch of conditions that go into that, doesn't always apply. And yeah, Zach mentioned the person who did the study, the person who published the original report, I think said he would be terrified, to have people using it.
Wow.
You could, but that is what the 4% rule is.
Awesome. Well, is there anything that we haven't spoken about so far today that feels important to bring into the conversation now? And if not, I have just one more question for you, Andy.
Yeah, I think there's only one other thing I want to say, which is just, I think the most important question people should be thinking of, and I've probably, harped on this a little bit already, is, how much can I accept the downside case here? Or, like a way to get at that is kind of, what if I'm wrong? if we have an assumption about what stocks are going to return over the next 30 years, like, what if you're wrong? Like, I'm not saying you are. Like, you should ask yourself. I should be asking myself as an advisor. I should be asking myself. We should all be asking, what if I'm wrong? What are my assumptions that are built into this? And can I afford to be wrong? And then rethink it if if you don't like the answer.
Mm-hmm.
Yeah, and it goes back to kind of the optionality and the flexibility, I would say, right? You don't
Yes,
want,
absolutely.
you might have diversification, but you don't want your one plan going in one direction. That's not how life works sometimes.
And it seems like a useful model to use for really, like, I'm thinking about, I'm not a homeowner yet, but if I overextend myself and buy a house that's at the top of my range, and I have a built-in assumption that the costs that I'm going to sink into the house, like I can afford what I'm expecting, but there's a chance that it might go over that. If I'm not asking myself, what are the implications of what that would be? What if it does go wrong there? Then I'm really setting myself up for failure. And as it's really a question that you can use for all areas of your finance. So, I mean, if people just left with that takeaway, I think that would be really helpful. And you gave many more takeaways. But the final question that I ask it's only been 3 so far, but the final question that I've asked in the previous 2 and that I'll ask in all future interviews is, what does it mean to you, Andy, to be wealthy?
Yeah. To me, I think, I had my personal experience with this is, I think there's kind of you're born, I'm reading a book called Debt, the Last 5,000 Years. It's long and dense, and I don't know if I recommend it broadly, but there's a lot of ideas of, like, how debt has played into society and what it has meant to people. And then there's like this kind of recurring idea that, like, we're born with a debt, and I think in a way that plays out right in the modern economic system. Like, kind of by default, you don't get to just do nothing. Like, you have a debt that you need to pay off. Like, you have to start working and, like, feed yourself. Like, it doesn't come from anywhere. Like, there's just sort of this threshold you have to pass. And I think getting those basic needs met is kind of a form of it. It's like a way of getting past that debt where you're like, I actually have enough that, like, what that debt I was born with, having to work to get to a point where I can survive, is really a huge component of it. And then I think if you are ordering at a restaurant, things that typical people actually do on, like, a normal, on a regular basis, and you have to think about whether you're going to get the appetizer or not. Like, these are sort of like daily decisions, and when you stop having to think about them, like, it really actually won't impact you anymore. That's where you can start to see, like, having a little more actually does make you a little bit happier. People are always like, more won't make you happier. Like,
get the avocado.
There's like, do you want the toppings? Like, you know what I mean? Like, not having to ever think about that, and, like, knowing that it's actually not a factor for you, that's not going to move the needle one way or another, is like a form of wealth. I do think that, like, there is definitely points after that where like, taking that extra vacation might not hurt you. When you start to think about, like, the private jets and, like, the marginal returns really do decrease. And I think that, like, wealth doesn't take a lot. There's definitely steps to it. I think once you kind of get to that point where you can relax a bit and you know what you're going to do in these cases, and some of these decisions people have to make on a daily basis aren't things you have to worry about. That's, wealth to me. I think that some of the things that you get by doubling that amount, you're just not going to see the impact. You're not, could be less happy. You could be equally happy. I don't think those things are required for wealth, but I think that understanding where you're at and knowing that you are going to have enough is the definition of wealth for me.
Awesome.
Stress-free life with freedom is what I'm hearing.
Yeah.
And another thing that I'm hearing, so I'm leaving with another takeaway here, is that if and when we ever go out for dinner, apps are on you, Andy.
Yeah.
Well, thank you both for the crash course on risk and decision making. There was a lot of information in this episode, so I think people are going to want to listen back. And I'll hand it to both of you. Do you have any parting words for the listeners? And if not, then I can do a little sign off here.
No, this has been great. Thank you so much again.
Awesome.
Yeah. Thank you for everybody listening. And I think that, I actually heard a quote. I'll maybe end it with this. I heard a quote that said, and it doesn't have to do with finances. It says, if you are trying to love yourself, you already do, because that's where the trying is coming from. So what I would say is, if you're listening to these podcasts and you made it to the end of this episode and you're listening to me say these words right now, just keep doing what you're doing. Like, stay curious, stay hungry, keep trying to find what the best path is for you, because it's going to be different for everybody. And I truly do believe, I don't know if it's exactly that you're the average of the 5 people that you spend the most time with, but your inner circles matter. So where you're getting information from, who you're speaking to, I would just say, pay attention and make certain that it's in alignment with what you're trying to achieve. But once again, just really appreciate everybody listening. Andy, you're a rock star. Always appreciate your insight. And Mike, thanks for running the show and steering the ship. So maybe I'm wrapping up this time, Mike.
Thanks everyone for listening. You did an amazing job.
Awesome. Take care, everybody. Thank you.
Bye.
Hi, everybody. This is Zach Smith, co-founder and CEO of I Am Financial and the co-host of The Other Side of the Coin. Please remember to subscribe and like. And if you have any questions and or would like to speak, please feel free to email me directly at zacksmith@im-financial.com. That is ZAK Smith at the letter I, the letter M-financial.com. Reach out to us and we will make certain to get you to the appropriate channels. Thank you again, and we hope you enjoyed our show. See you next time. Disclosures. This podcast is for informational purpose only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and the firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, Northeast Financial Network, and I Am Financial, and the opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, and accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. OSJ address is 101 Crawford's Corner Road, Suite 2405 in Homedale, New Jersey, 07733. Their phone number is 908-709-0020. Our phone number is 914-603-8325. A member of the Northeast Financial Network, financial representative with Guardian Life Insurance Company of America, New York, New York, I Am Financial, and Northeast Financial Network are not affiliates or subsidiaries of Guardian. Arkansas license number 16303-838, California license number 4108463.